Hello guys, what's up? This is your financial management tutor, Sir Uzair Awan, and welcome back to another video. In this video, we'll be solving another past paper question called the Hawker Company, which is related to the chapter Investment Appraisal. And this is a question of lease and borrowing. So let's start with the question. Let's read the question and see how to solve it. All right. So the question says that Hawker Company is about to replace its existing delivery vehicle with a new design of vehicle that offers greater fuel economy. It estimates that the replacing of the existing vehicle will save running costs of $2,000 per year. There are two financing options. Option number one, the vehicle could be purchased for $34,000 using a bank loan. Now, one thing that you guys always need to remember is that whenever we have a question of lease or borrowing, the only options that we have or which is required from us is basically to evaluate that whether I should borrow the money which is required to make the purchase from the bank, or whether I should lease it. So these are the only two options, and we have to basically evaluate it and then tell them that which one is better option. Okay, so for that you always calculate the NPV of both the options, and then obviously whichever would have the greater NPV, that would be selected. Okay, so now let's continue with reading the question. So we were looking at option number one, where they told us that the vehicle could be purchased for 34,000 using a bank loan with an after-tax cost of borrowing of 4% per year. The vehicle would have a useful life of 4 years and would have a residual value of 14,000 at the end of the period. So guys, we have our residual value, we have our investment. Okay. The straight line tax allowable depreciation is available on the vehicle. The vehicle would be subject to a government CO2 emission tax of $600 at the end of each year of operation. Emission tax expenses are corporation tax deductible, which means that you are going to get some kind of saving on these emission tax because they are corporation tax deductible. Okay. So we'll discuss more of this when we come towards the solving of option number one. Let's read option number two. It says the vehicle could be leased for a period of 4 years for a payment of 6,000 per year payable at the start of each year. The lessor will pay the CO2 emission tax. Lease payment are corporation tax deductible again, which means that there's going to be saving on lease payments taxes also. Okay. And then it says Hawker Company's after tax weighted average cost of capital is 8%. It pays corporation tax at a rate of 20% 1 year in arrears. Okay. Remember that tax is being paid 1 year in arrears and the tax rate is 20%. Okay. Now, one thing, remember that option number one, option number two, either you borrow the money or you lease it. Both options are related to debt. And for debt, we always use the after tax weighted average cost of capital, which is 8%. Okay. As our discount factor, remember that we are going to use 8%. Okay. Now, what is required from us in part number A is to evaluate whether Hawker Company should use leasing or borrowing as a source of finance for the new vehicle. So, this question we'll be just doing the part number A. Okay, the objective of today's video is to do part number A for Hawker Company. Okay, we won't do the part B and part C. All right. So let's start with the question. So first of all, like I said, we have to calculate NPV for both the options. Let's start with option number one first. Okay. All right, so let's look at our number of years. So it says a vehicle useful life of 4 years. A vehicle would have a useful life of 4 years. A vehicle would have a useful life of 4 years. Okay. So you know that year 0, we start from year 0, then we have year 1, year 2, year 3, year 4, which is the useful life of the vehicle. And I'm also going to write year 5 because you guys know that there is tax which is being paid in arrears. All right. So over here, I have my years, and let's copy them and bring them down over here. All right. So now I have my years, and now you know that the first thing we do is to write our investment. That's how I always start my question. And that's how I teach my students that always start from investment first. So our investment, as you guys can see, is 34,000. Not to forget that investment is an outflow, so I'm just going to put the negative sign with it. Okay, an investment is always at year 0 unless the question state otherwise. All right, after that we have our residual value. That's the second thing that I always take, my residual value. And residual value, you guys know, is always at the end of the life, right? So that is going to be year 4. Let's see what's the residual value given to us in the question. So it says the vehicle would have a useful life of 4 years and would have a residual value of 14,000 at the end of that period, which means at year 4, our residual value is going to be 14,000. Okay. And then you guys know that I always calculate my contribution, but over here we don't have the selling price, we don't have the variable cost, so therefore there is going to be no contribution. After contribution, I always work on the fixed payments, but in this question, in option number 1, there are no fixed costs, right? So ignore that also. Then we have the tax payment, but again, since we don't have the contribution and the fixed cost, there is going to be no tax payment. But what we do have is a CO2 emission tax, right? And on that CO2 emission tax, we are going to make some savings, right? So let's do tax saving working. Tax saving, and I'm going to place the W sign just to show the examiner that I'm going to be doing working somewhere, and let's do it over here. Okay, so let me just first quickly copy down my years. All right, after copying down my years, you guys know that I am going to write the tax. So what was the CO2 emission tax? So CO2 emission tax, as you guys can see in the question, it's $600 at the end of each year of operation, right? So I have $600. So I'm going to write 600, right? And then 600. And basically you can just copy this and paste this for year 3 and year 4 as well, right? Now for year number 1, I'm going to pay a tax of how much? Of 20%, as you guys can see over here, right? But that's going to be paid in year 2. Why? Because we are paying in arrears. Okay. So 1 year in arrears. So that means that year 1 tax is going to be paid in year 2, year 2 tax is going to be paid in year 3, year 3 tax is going to be paid in year 4, and year 4 tax is going to be paid in year 5. That's why I made an additional year of year 5 already before end, right? So 600 into 20%, that's 120, right? And obviously the tax is going to be the same for the rest of the year as well, since the emission tax cash outflow is the same for each year. Okay. After doing this, I'm going to come back to my tax saving. I'm going to press equals to, select 120 from here, and then I just press Ctrl C, select the remaining cells and press Ctrl V, which is paste, so that it can paste the remaining values. All right. Okay, now this tax saving that we have calculated is basically on the CO2 emission, right? It's basically on CO2. So I just mentioned that. All right. And now I'm going to calculate another tax saving, which is basically going to be on my tax depreciation, right? That is going to be my capital allowance. Okay. And we are going to do working of that somewhere over here, just like the way we have learned in our classes. So let's see if it's reducing balance method depreciation just like it is in most of the question or not. So as you can see, it says straight line tax allowable depreciation. So that means it's not the typical reducing balance method that we see in most of the question. Over here, it's straight line. All right. So for straight line, obviously, you will have to take the investment, subtract from it the residual value and divide it by the number of years, right? So we know that our investment was how much? 34,000. I'm going to subtract from it the residual value, which was 14,000. Close the bracket and divide it by the number of years, which is 4 years, right? So this is our normal depreciation formula for straight line method, right? So I get 5,000 worth of tax saving. All right. Now, obviously, this 5,000 worth of tax saving is basically the tax saving, and it's going to be same for all the 4 years, right? So I'm just going to select the cells and Control V so I can just quickly paste it for the remaining years, and not to forget that now we will calculate the tax on it. So it's going to be, 20%, not 30%, 20%. It's over here, 20%, which is paid 1 year in arrears. So again, the logic remains the same. That year 2 tax is going to be paid in year 3, year 3 tax is going to be paid in year 4, and year 4 tax is going to be paid in year 5. Okay. So that means 1,000 in year 2 and year 3, year 4, and year 5, since the tax amount is same for all the 4 years. Okay, so I can do the same for my tax saving capital allowance, that I can just paste it in year 2, then control C and control V to paste for the remaining years. Now you can see I have my investment, my residual value, my tax savings, both of them. And I don't think there is anything more to add to it. No, we are good enough. Now what we have to do, we have to calculate our net cash flows, right? So how do you calculate your net cash flows? So we will just sum these cells, control C and control V for the rest of the year. So it's gonna, do for all the years. Okay. And now we'll have our discount factor. So for discount factor, you guys know we use this formula 1 over 1 plus I. I is the discount factor, the discount rate, which is going to be after tax. I already told you guys that since both of them are debt options, so we are going to use the after tax weighted average cost of capital, which is 8% as our required rate. So 1 over 1 plus I to the power of n, and it's going to be 0 since we are standing at year 0, correct? Year 0, okay? Oops. Year 0, okay? And now I'm just going to control C and control V for the rest of the year, and all I have to do is to just change the year for each one of them. So that's how I'm going to do it. Year 2, year 3, year 4, and then finally year 5, okay? So now I have my discount factors, and I'm going to multiply my net cash flows with my discount factors to get my discounted cash flow, okay? So how do you get a discounted cash flow? You take your net cash flow times it by discount factor, and you only do this for the first one, because for the next years you can just control C, select the remaining cells, and control V, so it's going to do for the remaining years, right? Okay, now let's just quickly format these values. All right, and now let's calculate our NPV. So in order to calculate the NPV, you guys know that we apply the sum function, and we select our discounted cash flow from year 0 all the way to year 5, and that's gonna give me my NPV worth of 20,274. Okay, and you can see that it's negative. You can see that it is negative. Okay, so we have a negative NPV. Okay, after rounding off, I got 2275. Negative 20,275. Negative 20,275. That's my NPV for option number 1. So guys, here is option number 1 working in front of you. Now we'll move to option number 2 working. Okay. All right. Now let's start with option number 2 working. So I'm going to come over here, and I'm going to write that now we are starting with option 2. Now option 2, as you guys can know, is for lease. And for lease, I told you guys during my classes also that you only have 2 relevant cash flows. The first one is your rental expense, and the second one is any tax saving given to you in the question. So over here, we know that our rentals are 6,000 per year. So it's going to be the same for all the years, right? And there is a tax saving, right, which has been communicated to us in the question. It says lease payments are a corporation tax deductible expense. So that means that lease payments are going to be deducted as corporation tax. Therefore, you're going to get saving on that, right? So let's just quickly come to our option number 2. Okay. So first of all, we are going to write our rental expenses, and let's read what it says about rental expenses. It says the vehicle could be leased for a period of 4 years for a payment of 6,000 per year, payable at the start of each year. Okay. Start of each year, at the start of each year. Okay. Now remember one thing. I have told this in my classes also, in my previous videos also, that these years that we have 1, 2, 3, 4, these are all year ends, right? Okay. So year 1 payment you are going to make at year 0. Why? Because it says payable at the start of each year. Payable at the start of each year. Okay. So now I can just copy this and paste it for remaining years. Okay. So that's going to be 6,000, 6,000, and 6,000, right? Again, it says payable at the start of the year. So for year 1, you paid at year 0. For year 2, you paid at year 1. For year 3, you paid at year 2. And for year 4, you paid at year 3. Okay. And remember that the rental was only for the 4 years. Okay. Since you're only leasing it for 4 years, right? And then after having the rental expense, what did I say? The second relevant cash flow is the tax saving. So the tax saving that you're going to get is on your rental expense, as the question says that lease payments are corporation tax deductible. So that means that these lease payment that you are making, you're going to get tax saving on them. Okay. And you guys know that tax was 20% payable in arrears, 1 year in arrears. Okay. Okay. So I'm going to come at year 2. I'm going to select the rental expense of year 1, which is 6,000. Okay. And you guys know that year 1 rental expense was paid at year 0, but it's still the year 1 rental expense, right? And I'm going to times it by 20%, which is my tax rate. So that's my tax rate of year 1, which I'm going to pay at year 2, because again, it's being paid in arrears. Okay. Similarly, for year 1, I'm going to select 6,000, times it by 20%. Okay. So that's going to be paid at year 3, because it's basically the year 2 rental expense, right? And then you do the same. So now you guys know that the rental expense are same. So it's going to be the same for the year 4 and year 5 as well. And that is it. We have our 2 cash flows that are relevant for lease. Okay. And now again, we are going to calculate our net cash flows. So for that, I just have to sum these. So sum, close bracket, Control C and Control V for the remaining of the year. It's going to do the calculation itself automatically. And now I'm going to multiply this with my discount factor. So discount factor, we already calculated that in the first part. So let's just copy that from here so that it saves our time, right? Because the discount factor is going to remain the same since your cost of capital, which is 8%, is the same. Since your cost of capital, which is 8%, is the same for both of the options, right? Now I can calculate my cash flows by multiplying net cash flows with the discount factor, but do not forget that your rental expense are your outflow, right? So there should be a negative sign, which I forgot to put. So we are going to place negative sign with all of them, right? Okay, since rental expense is an outflow, so you need to make sure that you place negative sign with all of your rental expense. Okay. And now you can see that it has placed the negative sign with tax saving also, which we need to remove, because tax saving is not an outflow, it's an inflow, right? You are saving your tax. So therefore, instead of selecting, this cell, because it's going to connect with the cell, just manually type 6,000. That's better. So you see you have 1,200 now. Okay. Just Control C and Control V for rest of them. And there you go. Everything is sorted out. Okay. So I just forgot to put the negative sign with the rental expense. Remember that rental expense is an outflow. Therefore, you put the negative sign with rental expense, and tax saving is your inflow. Therefore, it remains positive. Okay. And then you can see now we are going to sum them. So now we have the correct values and we are going to multiply them with our discount factor to get a cash flow. So I'm just going to do that for the first year, as you guys know. And for the rest of the years, I can just press Control C, select the remaining cells, press Control V, and it's going to do it for me. Okay. And now I can calculate my NPV. So for that, I have to just press equals to, apply the sum function, bracket open, select the cash flows from year 0 to year 5, bracket close. And there you go. I have my net present value as negative 17,782. Okay, so now you guys can see with both the options, option number 1 and option number 2, I have my NPVs, both are negative. So whenever both are negative, you select the one, which is the least, right? Because think of this as both the options are giving you an loss, right? So whichever gives you less loss, you're going to select that, right? So 20,275 worth of loss or 17,782 worth of loss. Which one is lesser? Obviously, the second option. So you're going to just type it over here that therefore Hawker company should opt for leasing option being the lowest cost option available, right? So let me just write it over here for you guys that therefore Hawker company should opt for leasing option since it is the lowest cost option available. All right. And with that, our part number A is complete and the objective of today's video is also complete. So I hope everything is clear to you guys. If there's something that is still not clear, you guys can always comment in the comment section, or you can find my number in the description of this video and you can just, directly contact me, and you can always directly contact me and ask any of your queries if you have, and I will try to respond as soon as possible. Okay, so hopefully now I'm going to meet you guys in the next video. Till then, take care. Goodbye.